founders are very maniacally focused on what it is they're doing. So they kind of see the venture capitalist as like the check writer that can just, if they could just convince them to write the check, they can get on with what they're doing. So they don't take the time to understand what our investor base looks like, what our economics are, how it is we're going to survive in our own business. Because we ourselves are entrepreneurs with a business model and a strategy that we're trying to execute against. And so understanding this firm just started, they need to make a certain return. Am I going to be delivering that return if I hit all the milestones? And if they pay this price that I'm asking them to pay? That's the part that most entrepreneurs really aren't paying attention to. They're so focused themselves on what they are doing. They're focused on their product, and their customers are rarely focused on the VC's business model. And they're sort of just they're just going to throw money at me and then I'll make money for them.
Welcome to the Invisible Inc. podcast. I'm your host, Shubha Chakravarti, Chief Financial Storyteller at Achieve. Our guest for today is Eileen Tanghal. Eileen is the co-founder and managing director of Black Opal Ventures, an early-stage venture capital fund investing in hard-tech healthcare. She has almost 2 decades of venture capital experience and has sat on the boards of over 40 high-tech companies in the US and Europe as a venture capitalist. Previously, she was senior partner and managing director of In-Q-Tel. Eileen has an engineering degree from the Massachusetts Institute of Technology and an MBA from London Business School. Now, here's Eileen. Hello, Eileen. Welcome to Invisible Inc. We're so excited to have you here today.
Thanks. It's great to be here.
You've had a pretty varied, interesting career. I was looking at your profile and we've talked about this. You're a VC now from a very different set of backgrounds. What was the biggest motivator for you to get into venture capital?
Actually, I never intended to become a venture capitalist. I was an engineer by training, and I joined a venture capital-backed startup after MIT. And then after that, I joined another venture capital-backed startup, which was in the heyday of the dot-com. And that company, unfortunately, did not make it. So I decided, but I had done a transition from engineering to product management. And as a product manager, I realized that there was a skill set around marketing and finance that I was lacking. So I went to business school really to be a product manager. And it's during business school that I was recruited by a venture capitalist for a summer associate job. It was not something I was seeking out. And that, of course, then turned into what has now been a 24-year career in venture capital.
So now you head up Black Opal Ventures and you have your own venture capital firm. Can you tell us a little bit about this firm and your thesis there?
Definitely. So at Black Opal Ventures, we are really trying to find companies using frontier technologies for good, starting with healthcare. And it started with this premise that in order to truly find the most innovative solutions and solve the world's biggest problems, you need to collide worlds. Industries in isolation usually stagnate. And so you need to bring in new thinking, new ideas from maybe a different industry to disrupt what you're in. And so that is the premise of Black Opal. My co-founder and I have known each other since our MIT days. And for a long period of time, she was, our worlds really never intersected. She was a healthcare professional, so trained physician, and then a professor in medical school, and then she worked for a startup insurance company. And I've always been a deep tech investor. And we realized that in about 2019, our world started colliding a lot more. So what that led to is us investing our own money and then starting Black Opal as an institutionally backed firm, really colliding my background in deep tech and semiconductors, AI materials, with her background in healthcare and life science. And again, frontier tech for good. And then specifically in healthcare and security, we are taking technologies which we consider the ABCs of deep tech. So that's AI, bioengineering, compute, connectivity, and cybersecurity. and applying them to improve the 4 Ds. We call it 4 Ds that underpin health and security. And those are diagnosis, delivery of care, drug discovery and development, and then defense, like a biodefense.
Interesting. I love the ABCD version of it. So you mentioned this collision, right? Are there trends that you're seeing that are making that kind of collision more likely, so that now becomes an opportune time for you to have this kind of a thesis?
Yeah, I just gave a talk on this at the Atlantic Health Innovation Day. And I like to point the parallelism between, defense and intelligence and the healthcare system. So I didn't really introduce kind of my background, but after I worked for a venture capital backed startup and received my MBA, I've been a venture capitalist at, 2 financial venture capital firms in the UK. Then I ran the venture capital fund of Applied Materials and ARM as a new business ventures. And then most recently, I was a senior partner for In-Q-Tel. In-Q-Tel is the venture capital partner for the CIA. So effectively investing in defense and intelligence agencies, their use cases. And as I mentioned at the Atlantic Health Innovation Summit, at In-Q-Tel, they have about 800 companies to date, half of which are used in operational use cases that have just saved thousands of lives. We made all these investments in enterprise companies, field technology companies, and tech bio, but really it was against this framework of investments that enable data collection, data interrogation, and then action. And in the healthcare industry, this is exactly what doctors are doing and caregivers. They are collecting data, they are interrogating that data, and they are acting on it. So it's, of course, anything that you do from an AI point of view for an intelligence agent is highly also relevant to a healthcare professional. And we saw this already, that was the thesis of the fund. I was doing all these investments in AI, and we knew that it would be relevant in healthcare. And so I'll give you some examples. Originally, from a data collection point of view, you're usually just investing in like novel sensor imaging technologies. Now with AI, you are turning these sensors and imaging into some things that are much more, they're smarter, because you can put a machine learning model at the edge next to the sensor. So you might have been using that originally for defense and intelligence, but now some of our portfolio companies put ML next to the sensor to detect if you are about to have a seizure, or if they have to modify your settings so that you don't get a sore if you're sitting in a wheelchair too long. So that's one example of ML moving from one area to another. On the data interrogation side, same thing. We made an investment in a company called TigerGraph. It's a graph database company. And originally, graph databases were used for cybersecurity and understanding potential threats. They're now being used by healthcare and insurance to understand the effectiveness and efficiency of certain procedures. And then on the act side, so the autonomous, the systems side, I made a lot of investments in connectivity and in autonomous systems, robotics. And again, you see that entering the healthcare industry. So it's highly relevant, this move. Now, I'm talking about AI 1.0, which is, for the most part, reactive, simple, still, automated, still requiring a human in the loop. What's happening now is a move to agentic AI, which is going to be much more proactive and more complex. And effectively, the human in the loop element is going to get out. Now, in this world of a shortage of healthcare professionals who've been burnt out or just cannot keep up with the waves of information coming in, this idea of agentic AI, which allows hospital system to have a digital workforce and a human workforce, really is going to let them move them into the future. And so this is going to happen in the next 5 to 10 years, again, underpinned by all those frontier technologies that we're investing in. So that's why we're very excited about this space, because we see this move from, AI 1.0 to agentic AI, really collapsing that framework of collect, interrogate and act without a human in the loop, and causing all this efficiency and really addressing the unaddressed problems in healthcare, which are, a lot of medical errors, a lot of inefficiencies, a lot of patients not having access to care. So that is why we're excited about this space.
You got me excited too. This is actually one of the rare cases where I've heard about AI being applied in a really thoughtful manner as opposed to being slapped on every single business idea I've ever heard of. So awesome.
Thanks.
So I want to jump into, one of the big themes that we hear with founders is this lack of understanding of what a VC exactly does and what really drives their behaviors, right? So I want to dig a little bit into that. Starting off, what do you think is one thing that founders most miss about dealing with a VC or about getting VC money?
So I think, I sort of mentioned this to you. Founders are very maniacally focused on what it is they're doing. So, they kind of see the venture capitalist as like the check writer that can just, if they could just convince them to write the check, they can get on with what they're doing. But sometimes they don't take the time to understand what our investor base looks like, what our economics are, how it is we're going to survive in our own business. Because we ourselves are entrepreneurs with a business model and a strategy that we're trying to execute against. And so understanding, wow, well, this firm just started, they need to make a certain return. Am I going to be delivering that return if I hit all the milestones? And if they pay this price that I'm asking them to pay? That's the part that most entrepreneurs really aren't paying attention to, because again, they're so focused themselves on what they are doing. And so they're focused on their product, and their customers are rarely focused on the VC's business model. And there's sort of just they're just going to throw money at me and then I'll make money for them. So that's probably the one thing that, I've seen. Yeah.
So if there's one thing, understanding that obviously the founder's there to take care of their startup and not yours, right? Is there one thing that they can do that you think will make life easier for you and their chances better off to that point?
Yeah, I imagine that, just as always, we are partners and that are trying to come together to find mutual success. So if you just see your partner as sort of this sugar mommy or sugar daddy or whatever these terrible terms are, then you're not going to be thoughtful about asking them, what is their motivation? When did they raise their last fund? Are they raising a new one? Why? What's the strategy? Do I fit into your strategy? The entrepreneurs rarely take the time to ask that of you. Sometimes it's because there is, of course, a power dynamic there. They're asking you for money, so they don't want to pry. I think just a tip might be when you approach the venture capital, be like, congratulations on raising your fund. Congratulations on some of your great companies. I've seen some of the companies you've invested in. I'd like to be part of it. So just, doing some more research about who it is you're talking to. And boy, I really think we would fit with you because you seem to like to invest in this space. Also, I know you all are motivated to do very well. It's your first fund. I think that I could deliver that for you. So there's a little bit of a framing around the needs of the VC rather than I'm just here to convince you that I'm a really good entrepreneur and I have a great product.
So I'm hearing that having that light touch, subtle approach around acknowledging where you're coming from and what your worldview is a good thing and counts in their favor.
That's true for your customers, right?
True.
For your, it's so interesting. So the CEOs usually know how to do this for their customers. Even when they're recruiting employees, they know how to do this, right? So they say, okay, please come and join my startup. I know this about you. And I think, but when they talk to the venture capitalists, that is not necessarily applied. So you often will hear, they'll contact you, they'll talk to you, and they didn't look up like, how big is your fund? They didn't even take the time to do it. How big is your fund? What have you invested in? Who are you? like, oh, might you like this? Like they don't do it. They just, again, they think that 100% job is to just talk about themselves and their company.
Which brings up a really interesting point, right? This obviously how good the company is a big part of your decision process, but there's a whole other set of factors around you, the fund, things that are non-startup related. So what are the biggest non-startup related factors that drive your decision in whether to invest or not? And can you just talk about how they impact your decision at any given point?
Yeah, I mean, that's a very broad question. So, there is your own personal motivations, and then there are what you have promised your investors you will fulfill, and then there's what you have agreed with your partnership. Okay, so those are the three kind of layers of what is someone is deciding, why someone is deciding to say yes or no. So there's gosh, Eileen, really like cybersecurity deals. I've always liked them. This is what I like to invest in. So motivation, check that partner. Then there is okay, I told my investors that of our portfolio of 30 companies, we would do 5 cybersecurity investments, and I've already done 4 of them. So there's only 1 left. So now that's going to change if you're the 5th person I'm talking to versus if you were the first person I had a slot of 5 to fill. So that is kind of that second bucket of what did I tell my investors I would do in my fund? And then third, there's a dynamic between each partner and the partners together, right? So if you're in a portfolio of 30 companies and there's like 5 slots back, and one partner is the one that has all the returns and has done really, really well, and they want to do a deal, and that deal is competitive to yours, then they may win. So that has nothing to do with you. That has everything to do with the partnership. So those are outside your sphere of influence. It's just the partner himself or herself, whether or not you fit into the strategy or at what point you fit into the strategy, and then the dynamic within the partnership itself. Like the other example might be like, okay, this is now the 5th cybersecurity company you're bringing to us, Eileen. You have lost money on all the other 3. Why should I even believe you the 5th time around? And that's, again, you could be a great company, but that has nothing to do with you.
So that brings, obviously there are a lot of these things and there's just no way for them to be knowable to a startup founder. So from a practical implication standpoint, right, there's the first step, which you talked earlier about, hey, just do the basic diligence and understand what kind of fund this is and what the partnership and the fund is doing, right? Check that box. But beyond that, is it fair to say that the actionable implication is make sure that you've really scrubbed your list of your target investor list, and then it's a numbers game beyond that, because these are all, it's kind of like college applications in some sense, right? Like you control your application, but you don't control, how many people they want from the Midwest and so on.
Yeah, that's right. I think that's a fair assessment, but I think, just like it is possible for you to understand with all the information out there today, what a university cares about, what is the culture of the university, talk to the people that have attended that university. It is possible for an entrepreneur to do the same thing, right? Oh, you got funded by this partner. How was it to work with them? Great. Do you think they would even look at us? What is their hot button? Not, So I agreed, there are people that, I remember when I was applying, all you had, you barely had the internet, right? So you bought this book and then you looked through the book and then that's how you decided who to apply to. And then I didn't even get a chance to visit most of the ones I applied to. I think in this day and age, you shouldn't have to go so cold or blind into an investor meeting. You should indeed procure, just like universities, who is going to be the best fits. And, I sometimes I hear a lot of excuses that are like, well, we can't afford the database that has its like, really, I know, I'm not sure that's a really good excuse. There are plenty of not that expensive databases that give you the lists of investors and what they've invested in. And then, of course, they have their website so you can see what they've invested in. And if you really know your space and what you're doing, if you look at the next 10 or 15 companies in your space and just focus on those and who invested in them, that will also kind of give you a list of who might be useful as investors.
Great points. And one last thing on the topic of VCs in general, which is this question of driver returns, right? And how a VC looks at returns. Can you talk a little bit about how you're looking at returns and how the actual returns play out in terms of your overall portfolio and therefore how they might influence the decision?
Yeah, I'm probably not going to give any new information that you won't hear from any other venture capitalists. In general, venture capitalists need to be at the top quartile. They have to aim to be at the top quartile. Normally, what that means is that you have to be at least a 4x gross fund and 3x net fund. What do I mean by that? If you're a $100 million fund, a gross basis would mean that you have to make $400 million on your investments. Now, if you're a $100 million fund, of course, you're charging fees to your investors. So your investable capital might really be more like 80 million. So it's like 2% a year on 100 million is about $2 million over 10 years is 20 million. That's hitting the fees. So then you can only really invest 80 and you want to make 400 out of that 80. So you better make 5x out of that 80 million. And then of that, what did I just say? 400, right? The reality is the nice thing is that you then pay back the 100 they gave you and then you share in the profits. So how do I get to that 400 or 400 out of 80? Okay. So if I have a portfolio of, call it 18 to 20 companies, which is what Black Opal is looking to do, the reality is you really can't afford that many goose eggs or zeros. So maybe you have a couple zeros. So if I take 80, this is not what we do, but let's just say I have 80 companies. I take half of that, so 40 million, and I invested in 20 companies. That's 2 million each company. And then the other 40, I hold back to back my winners, right? That's the normal VC thinking. If I lose, I don't know, 19 companies, I could probably lose 19 companies, and then one of those companies gets me a 10x. The thing is, I've only put in 2 million, plus maybe some follow-on. So the reality is that 2 million plus some follow-on, maybe I make 10x on that. So I'm going to get back 80 million or maybe 100 million. Then the reality is then I just invested 80 million just to get back 100 or 100 something million. So because I got 19 zeros and then just the one company hit. And so that's okay for that one company and maybe that gets me a 2x. But I got to make sure all those other companies aren't zeros. And they usually aren't, right? A couple of them are zeros. A couple of them are 2x. A couple of them are 3x, and so you add up all the ones that give you the 2x or 3x plus that outlier. And that's how you get the 5x that I'm telling you. That's how you get from you're investing 80 to 400. Because you're taking that small 2 million bet, you're hoping you make 20 or 30x on it, which is the 60 or the 80 or, and then the rest are being added up to get you the multiple to get you all the way to 500. And more often than not, you are not the outlier, right? So now what I'm talking about are companies that tend to be not in the seed and pre-seed. The death rate or the goose egg rate in the seed or pre-seed is much higher. So it's possible, you're going to have a lot more dying there, but if the seed or pre-seed fund hits with one outlier and they own a lot of it, then that can make up for all the kind of goose eggs. So there's 3 things happening here, right? One is at what stage am I getting into? The second is, what is the ownership I'm getting into? And the third is, what do I think these things can exit for? And then, so there's one more, which is the death rate, right? So hopefully that answers your question.
It does. It does. And that kind of leads into, this is the backdrop in your mind as you're evaluating specific companies for investment, right? And I want to dig a little bit more into that. So I want to go specifically into one, we understand the piece around the market and the fit and the traction, all of that stuff, but I really want to focus on the financial modeling piece because that's where there's a lot of fogginess for founders' perspective. So can you just walk us through, like, when you start looking at a startup's financial model, what are you looking at and what are the things that immediately are the big red flags, the big green flags, and some of the yellow flags?
Yeah. So the easiest way to kind of describe this is to go through the lines of the P&L, and then the last part is the starting and ending cash. So the first thing that what's in a profit and loss statement for a company, right? First is the revenues. And, are they being realistic about their revenues? Some founders will just say, this is how big the market is. And they'll do like top down and say, I can capture this percentage of the market. And so therefore, eventually I will get, so the simplest thing to do is like, it's $1 billion market. I should be able to 10% of it. So I'll get to 100 million and I will just double every year until I get there, right? So at the end, it's 100. The year before is 50. The year before that is 25. The year before that is 12, 6, 2, 3, 1. And then they build their business model like that, which is a perfectly acceptable way to build a business model. Fine. The part where it falls down is when you start asking them things like, what is the margin, gross margin that you're going to get when you're 1 versus 12? And they don't do the sufficient research to understand what can they really command from an A point of view or a price point of view? And then what from a supply chain can they really expect from a gross margin point of view? So that's tick number 1. Tick number 2 is, you're telling me you're going to double your revenues every year to get that 100 million. What is the ratio of sales to your sales and business development team? So your revenues to your sales and business development team, is that consistent? How are you getting there? Sometimes I'll see founders fall down in that what they do is they just keep spending a lot more on R&D and R&D and R&D. And then they don't grow sales and marketing heads very much. And that tells me straight away that this is a R&D founder that doesn't actually know how to sell business. Because what they have this mentality of, if I just build it, the customers will come. And so then they put a lot of money into R&D and development, and then the sales thing is an afterthought. So that's one thing I'd watch out for. Whereas the true operator knows that, okay, maybe I have 3 salespeople. These 3 salespeople each have commissions of $1 million each. And then eventually they might have 2 million. And then I have to build out more customer sales reps. Or the other kind of naive thing that I sometimes see is, I don't have to have my own salespeople because I'm just going to sign a big distribution agreement because this is going to be the best thing since sliced bread. And so anybody who will want to just buy from me. But then what they don't do is then they don't adjust the margin. Because of course, if someone is, white labeling your product, they are going to squeeze your margin. So that's fine, but you better take that into account in terms of your gross margins. So sales and marketing, we do the what you do in finance called commons analysis, right? Which is you take all of the expenses as a percentage of sales and you look to see what's consistent. So you're looking to see if you're overspending in G&A and OpEx. And then we go down. So that gets you to your EBITDA, and maybe you eventually get profitable. And hopefully you do. If you don't, then I'm not sure what the point of the business is. And then let's go below EBITDA. So cash that the business needs. In some cases, the CEOs, if they are a hardware business or require hardware, they underestimate how much capital expenditure needs to go in. So you need to put that in, because that's then going to determine how much you need to raise is there. And then finally, and this is a little bit nitpicky, but it's rare that the early stage entrepreneur knows how to project forward a balance sheet and knows how to project forward like days outstanding on invoices and that kind of thing. So their cash management point of view, they don't realize that even if you sell now, you might not get paid till 60 or 90 days out. So you might have a cash flow balance, but that's already in the advanced territory. We're talking about usually entrepreneurs are super early. So that's what we're looking at. This is just fundamentals of business, but using the P&L as a mechanism to inform the questions you ask around the fundamentals of business.
Before we dive back into our conversation, I want to tell you about Seed to Success. Seed to Success is our community letter with our proprietary insights on startup financial storytelling, tips, new episodes, and much more. If you find these discussions helpful in your entrepreneurial journey, use the link in the description to subscribe to Seed to Success today and get all of these and much more straight to your inbox every week. Now, back to our conversation. To what extent, I'm just curious from a practical standpoint. I mean, I've seen a bunch of founders not in the same verticals as you. And there's always to me, it's a dropout point. Like your financials aren't there, then it's clear to me you don't know what you're talking about. Is that something that you see as well? And are the financials ever a rejection reason for a deal?
I think that they shouldn't be, because accountants very rarely are good entrepreneurs. I know many a CEO that is not their strong suit at all. What they know is their business, and they have a vision, and they can attract people to that vision. But they're not very good at the numbers part. It is never a straight no for me, but a highly curious person, which is what I believe all CEOs should be, because we'll find the answer and learn it and try to learn it. So, and if they skimp on that, then that maybe tells you that they're skimping on other things.
So it's more an indicator of their leadership.
Yes, it's more of an indicator of that and how deeply thoughtful they are. So I don't expect them to understand the ins and outs of a financial model, but if I see them asking a lot of questions and or recruiting the person that can answer the questions, that tells me something about them as a person. Versus they're like, oh, I don't know that, I'll figure that out later, or I recruited this person and clearly that person doesn't know what they're doing. That tells you the kind of level of people that they're able to attract.
Interesting. That's the most interesting take I've heard on financial models so far. Thanks for that. So one other question, you mentioned this whole question of, how they come up with the revenue, you take your market size and, a market share. Is that the only way that you see the market size playing into the financials? Does it have other implications? For example, where do Sam and Som come into the projections, and what other checks are you doing to assess?
Yeah, realism? I mean, I hate to discourage, but the kind of amateurish way of doing SAM modeling or TAM or SAM modeling is I used to use this as an example, like, what is the total addressable market for blue jeans? Well, easy. The entire world wears blue jeans. So I multiply $100 by the entire world, and that is my TAM. Is it though? So learned a long time ago, and I continue to preach it, the holy trinity of marketing, which is segment, target, position. So this is about strategy, right? So are you really selling jeans to the whole world, or are you selling high-end jeans to people that make at least $100,000 a year and spend $10,000 a year in clothing and therefore will buy 3 pairs of jeans? Now that is your TAM. Okay. So you have to have some understanding of the segment you are absolutely going after and how you're positioning yourself in it. Not everybody who buys a Ferrari is also going to buy a Honda. I mean, you got to figure out where is your segment and who are you targeting. That's first. Then the second thing, right, is the price sensitivity or elasticity of demand for the people in that segment. So is your pricing that you're putting together something that they're used to paying? I've just told you, that's the volume of demand. Hey, there's 15 companies or 100 companies. Now, what will they be willing to pay for your service? And then the third is the competitive fragmentation that's going on. Now, in the jeans market, have there ever been anybody that's collected more than 5, 10, 20% market share? And if they have, can they stay there? Or is it that this is a highly fragmented industry that any player at most is going to get 2 or 3% market share? Okay. And so you're using all this. All right, I've segmented now to this pie. This pie is worth $1 billion. The competitor landscape is that there's one big player and there are 40 small players, and we're going to try to outplace the big player. Fine. And so if we outpace them, we're going to own 5, 10, 15% market share. That's fine. And then the next parts of, well, how are we gonna outpace them? Well, they charge this much, we're gonna charge this much, but we're gonna offer more value. So there's more to it than kind of the amateurish, like everybody wears jeans. Let me just multiply by the number of people who wear jeans. You have to think about this segment, target positioning, competitive pricing, route to market, barriers to entry, and then how much it costs for you to get there. Yeah.
So I love, all of that makes sense, but I'm getting the sense that you really are getting after what is the core addressable market. And I'm hearing less of a concern around the semantics of, is it TAM, is it SAM, is it SOM? Do you have any comments on SAM and SOM versus just the part of the market that you are actually going after?
Yeah, I mean, again, the biggest one is the SOM and SAM, right? That's where the thinking goes. The TAM to SAM, usually what you'll see is like, people will include everything into the TAM, and then they'll realize like, okay, yeah, I sell, the TAM is, let's say I sell sports equipment. The TAM for sports equipment is $100 billion. Yes, but of course, you're not selling all sorts of sports equipment. You're selling a Peloton. So what is the TAM for the Peloton, right? And so then that's their SAM. Sales addressable market are the Pelotons. The SOM is then the more subtle one that I'm talking about, which is where are you positioned in that market so that it's really your sales opportunity funnel or your true addressable market. And then how are you positioning yourselves in that? So that is what I mean by, kind of the TAM, SAM, SOM. But I'm more interested indeed in the thinking behind it.
That makes sense. So, you talked a little bit about the revenue. We talked about the model. We talked about TAM, SAM, SOM. I also want to look at it from the other point of view, which is you're funding a milestone, right? Or you're looking to fund a milestone. So can you talk a little bit about how you're evaluating milestones when you're looking at a company? How do they figure into your assessment, and what should a founder be thinking about?
So, again, we are in the business of creating financial outcomes, positive financial outcomes for our investors. Black Opal is also an impact fund. So we're making sure, of course, that your product is addressing the challenges in healthcare and security. So I'm not going to talk about the impact part. I'm just going to purely talk about the financial returns part. The fundable milestones for a company usually are around maybe 4 or 5 different big milestones in the life of a company. One is when a demo is made. Another is when the company actually has a first trial or pseudo-paying customer. The second is when it has multiple customers. And then you're growing, and then 5, somebody comes in and possibly wants to buy you if you decide if you're going to be bought or keep going. And then even in that end part, when you're growing, are you hitting revenue metrics that investors like to see, so that hockey stick, in SaaS, that used to be like the triple, double, 1, 3, 9, 18, 36 in terms of revenues. So those are the milestones. So we put that aside. But remember, we have to make sure that we are getting a certain IRR. So internal rate of return, that gives us the ability to raise our next fund because, again, I'm an entrepreneur handling other people's money and I need to return something. So the VC math to think about is if I want to make 30 to 33% IRR a year, which is what I need to do in order to be a top tier VC, then if I'm going to hold this investment for 10 years, then I need to make a 10x return. If I'm going to hold this investment for 5 years, I need to make a 5x return. And then 2 years, 2x, so on and so forth. Each of those milestones gets me closer to an exit, right? So that's why the valuations can go up because then I can hold for less time before you exit. So if you're at seed stage, and I think that it's going to take you 10 years to execute on that $100 million plan, then I need to get a valuation at that stage that still ensures that after you keep fundraising in that 10-year period and dilute me, I can still make 10x. The next milestone, which might be 2 years later, if you want a valuation, it still better be at a valuation that after 7 years, after I get diluted, I can still make 7x. So these are all fundable milestones of when a new possibility for a round is, because you're executing to your plan. But it has to be at a valuation where I can make my IRR. That's what I'm not, because, every single portfolio company that I'm trying to back has to have this potential of 33% IRR in the first place. Plus, I know that, the distribution of outcomes is so varied and wide that even if I, do this, I still may not get my 4 or 5x gross return because if a lot of more of these die off and don't give me those 2x's, 3x's that I mentioned. So, yeah.
So the kind of like the big message I'm picking up is that there are these 4 or 5 big milestones that are going to drive your prospects of getting the exit that you want to get, right? And then where you are in the process determines which of those milestones need to be, and therefore what is the what's the delta or the upside that you have relative to what you need in order to make the returns for your portfolio. So that's really what it boils down to from what I heard.
That's right.
So with that said, how are you evaluating a company's roadmap or a plan when they come in and say, hey, I'm raising at seed stage or Series A or whatever the case might be. Here's my plan to do the following things. And obviously there's a price tag attached to achieving those milestones. That's why they're raising in the first place. Do you have any thoughts in terms of how the founder should be thinking about those or how you would be evaluating the long-term milestones and the long-term capital plan relative to today's investment decision?
Yeah, so in every investment that we do at Black Opal, we always take into account the long-term model. Most companies, they're not necessarily projecting forward like until the exit. They are looking at, again, these are maniacally focused, right? So they're looking at how much they need right now, how much will they need the next 18 months, maybe the next 18 months after that. We are trying to take them through the whole cycle through exit. And we are modeling out how much we actually think they're going to need all the way to exits. Of course, they're more optimistic than we are, and in most cases. And then we model the dilution to our investment at this stage from those future rounds. The next thing we're doing is we are looking at what exits look like in that space if they were to hit that revenue or operational milestone. Will they get bought? Who will buy them? For how much? And then we use that to calculate what the eventual IRR will be. So that's what we do. We also do, probably like many VCs, 3 cases, a base case, a high case, a low case, and then we're weighting them based on how the stage at which the company is at. So in the low case or the 0 case, if you're at seed stage, you might have a very high probability of being 0. So we might give you like a 67%. If you're already growing, you might have a 10% probability of dying off, right? So So that's what we do. And then we take that weighted cash on cash or weighted IRR to determine whether that weighted IRR is meeting the threshold.
So this makes a lot of sense from your point of view and in terms of the business objectives you're trying to meet. And not a lot of this is actionable by the founder. But if there's one thing that is actionable, given that they should be focused on the business, is there one thing from an exit or a long-term capital plan perspective that you think they should be doing that will improve their odds of success?
So the venture capitalists try to help the companies with like what I call, the three main things. So one is customers, right? The second is capital. And then the third, which is the part that I think really distinguishes some founders from others, is the people that they're putting in place around them. And I know this is like everybody is saying the same thing, but this is back to the, how far out are you thinking here, right? So if you say, okay, I'm just trying to get to my first product demo. So it's just me and I hired a VP of engineering. And once we get the first product demo out, we're set. We're now going to go to the market and ask for more money. But what some of the better founders do is that they already know, they assume they're going to get to that point. So then they bring in as advisors a list of people, not necessarily as advisors, but they already have a working list in their head of who they're going to bring in at that point in time to take them to the next level. And they're already saying that to you when they're pitching. So they'll say, I've got this VP of engineering. VP of engineering right now and I are going to develop this demo. And then when this demo goes, then what's going to happen is this person over here, I've already been talking to them. They are going to come over and we're going to hire them. And they're going to sell, my demo to 10 of their customers waiting in the wind. And I've already talked to them about coming on in 6 months. That is the better founders are already. And then they'll say, and when we have 5 million in revenue, I'm going to take this COO over here, this CFO, who's so really wants to join us, but we don't have the capital to pay him or her. But the minute that happens, they're going to come. And they've lined up the kind of dream team to hit all the milestones versus it's just me and another person. And once we get this, see, look, we did it. Now you're going to fund us, right? Okay, now fund us. Then I'll go find people.
So there's a strong, maybe you don't intend it, but I'm picking up a strong undercurrent of repeat founders here because I already know what's going to come, right? So
no, I wouldn't say that because there's plenty of people that worked that have never founded companies, but they actually have business experience. If you have business experience, then there's actually plenty of people that have no business experience, but they are deep studiers of other people, or they have a mentor that has taught them. So I don't think you need to be a repeat founder, but this is back to are you highly curious and are you planning out your whole scenario? So, because you can meet a brand new first time founder, but they are thinking like way ahead of time of like, first I'm going to do this. And when I do this, I know I'm going to probably need somebody that does this. So I'm going to start looking for that. And then I know I'm going to need somebody who does that. So I'm going to start looking for that. But if you are a studier of business, and some of my best founders, they love to read like biography books of founders who are successful, and they learn from that. So I don't think it's that. I just think it's, are you trying to have a business or are you trying to make a cool widget? Which one are you? If you're trying to have a business, then you should understand how businesses become successful, not, I'm going to keep talking to you about this thing that I built and isn't it cool and and it solves this problem but that's not a business. It is a product. And so you hear a lot of founders that talk about that, and they'll talk about that for like hours, but they are not talking about building a sustainable business. It is like, I build this is great, Medtronic will buy it. I built this. This is great. Google will then buy me. And that's not what I mean.
I get it exactly. They're seeing the dots that need to fall in place before that Google buys them or Medtronic or whoever else buys them. So I think you did a great job modeling that out and laying that out for me. So I want to round this conversation out. It's been fascinating in terms of, okay, so all of this comes together in terms of somebody coming and making a pitch to you, and you're going to have to make a decision. Can you, for those of our founders who are not familiar with this, can you just give us a high level in terms of somebody pitches, what then happens through the process till the point where you either decide, yes, we're going to go ahead, or we don't think this is a good fit at this time?
I mean, it's very dependent on the venture capitalist. I think, usually in the meeting, right? You don't want to give the wrong impression to the entrepreneur. So if it's a clear no, then you're gonna, I tend to say that in the meeting. So it's like, look, it's I don't think this is for us right now, and you can give a myriad of reasons, but you're just going to get it. Now, if you're lucky enough to say, okay, this has piqued the interest of the person on the phone and they want to find more information, usually, at least we follow a 3-step process where if it's interesting, we then write a company of interest document that then gets discussed at the partner meeting. And if it's interesting, then we'll ask for a second meeting to go over some of the elements which are needed for our next stage in the process, which is a commit to deal, where a commit to deal means, okay, I'm going to start spending a more significant amount of my time on this company, getting to the bottom of these questions I might have. And the questions are always around, for us, like, is this really a big enough market? Are you really the only competitor here with a truly defensible competitive moat? Who are you as people? Do you have any experience in the thing that you're trying to sell, whether it be inside a company or not, or have you at least recruited other people around you? Did you put together some piece of technology that gives you an unfair advantage for a long period of time? And then obviously, do you have any sales already in this space? So those are the 5 that we're looking at from a qualitative. And then the easy no's from a quantitative is kind of the VC math, which is, all right, what was your last round valuation? Well, my last round was $100 million. Okay, well, do you have any revenues? No. Okay, what are the typical exits of companies in your space? Well, there's this one company that was worth $10 billion. And I mean, the founders love to say that. And you're like, yes, but what is the typical exit in your space? Well, 300 million. Well, then it's a no, because if the typical exit is 300 million, you're 100, then we're finished. As much as you might have filled the qualitative part. So, we're making that judgment call, or we should, in the beginning of, okay, the valuation is reasonable. We can see our way to the cash on cash that we need. You are meeting our criteria around market, management, competitive tech, sales, and I'm going to dig further. But I have to go to my partnership and say, do you agree that I should keep digging further? And then we dig, and then there's more, any one of those pieces, the rating changes as you keep digging. You'll either get better or worse. And then finally, for us, we do a full cash on cash analysis, which is informed by the diligence, right? So you gave me some financial model that says you're going to go from 1 to 8 to 16 or whatever, and that you're going to get this kind of gross margins, but I just did a lot of diligence and I don't think you're going to hit that plan. I think you're going to spend a lot more than you think. And so that's going to either mute or not mute my original cash on cash, but if it's still on a weighted basis, okay, I will still make the investment. So, we do a COI, C to D, C to N, C to C. We have 2 levels of diligence that we're asking for, one at the beginning to get you to the C to D or C to N, and then another one that is way more in depth, which is involving the lawyers and other people, like IP diligence, reference calls, that kind of thing, before we're making the close.
So from a founder's perspective, right? There, in terms of what the ask is and what I should be doing to improve my chances of getting funded. There's one what I'll call more macro, holistic, intrinsic factors, which are, am I the kind of leader and am I the kind of business person who's thinking ahead and doing all of these things that you talked about, right? Leaving that aside, from a specific deal perspective, are there things, obvious misses that you're seeing consistently that would be actionable tips or insights for founders to better prepare themselves?
Yeah, I think it's just back to like, there are plenty of very, very good businesses. Not all of them should be VC-backed businesses. So this is back to what is the return that you believe an investor can eventually, a realistic return an investor can eventually get from this? Think of this as like a house, right? As much as you take a house in a specific area and you bling it up with all this expensive stuff in the house, it doesn't mean it's going to sell for more than what most of the other houses in the area sell for. There is a natural range of houses in that space. I don't care if you put like, a gold statue in the front entrance. Is it no, it doesn't matter. So this is back to my, okay, you picked a sector, you're trying to do it, you're saying that this is the best house on the block. Should you really be asking for private equity or venture capital to back this house? Or should you just run it yourself and just use your own money or use debt or ask friends and family? It's not a venture capital thing because venture capitalists need to make 33% IRR.
So in some sense, you almost have to be an investment style thinker before you even decide to go down the VC.
You have to be a business person. This is back to are you a business person or are you a person that has a product? A business person is going to know, I can sell this many of this. I can eventually make this much money on this. And that's an equivalent to, making this much money for investors. But I don't want to say an investor mindset, but I do want to say that's a CEO's job if they're trying to raise money, is to understand what they're going to return to their shareholders.
Fair enough.
So it's like this, like, you're not trying to think like an investor. You're trying to like think like a CEO. That's what CEOs are supposed to do. CEOs are not just, I have a product and I try to sell it to my customers. Okay, that's fine if you don't take outside investment. But the minute you want to take outside investment, then you need to take your shareholders into account, just like the CEO of any company.
Fair enough. Point well taken. So one other quick question. I want to talk a little bit about, to the extent, do you have any thoughts for female founders in this space? Do you give different or additional advice pointers for them to be successful?
The only thing that I would say is that it is harder for certain groups like women, underrepresented founders, even people that, they aren't minorities or underrepresented, but they didn't necessarily go to the right schools, or I don't know what right schools mean, but let's say the schools that have heavy concentrations of venture capitalists. Their kind of challenge is to get that first money in. And so what will sometimes happen is the way that they bring in the first money is such that it actually might make it difficult for a proper institutionally backed venture capital fund to come in after. So just the piece of advice I give is like, just, if you're going to go after the non-VCs in the beginning, which is most people, to structure things so that is conducive to the venture capitalists coming in later. So that's probably the biggest piece of advice I could give for anyone that doesn't have the access to the traditional, or to the large sums of VC. In terms of, is there something specific to the female or underrepresented that I would say differently? Not really. It's back again to this just the people issue, right? Did you think ahead about who else you're going to bring in after? I think there are some founders who maybe believe that they need to be the be all and end all. So they're going to raise the money, they're going to do the books, they're going to do this. And that's probably not a good sign, right? Because they don't attract, better people than them into their company, which is what you need to do well. Yeah, I think those are really the two pieces of advice. I will say something, just being a female entrepreneur myself, because it is so hard. It's also sometimes unfortunate that you end up being on the defensive, right? It is because it's already hard. And then if somebody's like criticizing you, then you're like, let me prove myself. Like, let me prove myself again. Like, let me counteract whatever you're saying. And I would say just be careful of that, right? So if you're in the meeting and someone is giving advice or criticizing your plan or criticizing whatever it is you're doing, and you're a first-time founder, whether you're, I'd say specifically that is probably one thing that the females maybe they feel like they have to prove themselves, so then they retort quickly instead of listening or being open-minded about it.
So your concept to them is listen and give a measured response back and kind of sit past that.
Yeah, and I mean, the person talking to you could be completely wrong, and probably they are wrong versus what you know. So if that's the case, it's also just not worth debating, like, okay, they think that.
Thank you for sharing.
Listen, and thank you for sharing. But I suffered from this myself when we were raising for Black Opal, and people are questioning, our funding our strategy, our portfolio strategy, our way of doing this. Of course, my tendency is to be like, I've been doing this for a long time. I know what I'm doing. Like, there's no point in you saying that. The investor knows that you know what you're doing, or maybe you don't, but
there's nothing to be gained, is what I'm hearing.
It's not, yeah. And I think that you just got to be careful about not coming off arrogant or not listening. That's all. And unfortunately, it's possible that there may be a different bar being applied when you're talking. So you better just be careful about not sounding arrogant.
Love it.
Yeah, better to sound gracious, perhaps. Yeah.
Good counsel. So this has been a fabulous conversation. I'm just going to close with one last question. Is there anything that you wish I'd asked, but I didn't?
So you were going to ask me the three pieces of advice to give to entrepreneurs, I think. So I had written something down and I wanted to share that. And so, so in closing, I guess my three pieces of advice for any entrepreneur is test your model assumptions and try to pitch with a friendly investor. The second is, if you hear the same piece of advice 3 times from 3 different investors, you got to act on it. I mean, VCs are wrong way more than they are right. But there's usually some sliver of truth if you're hearing the same thing. Like, gosh, you really might want to get yourself a CFO, or gee, that is a lot of money for that. If you hear that over and over again, then take it into account. And then finally, on a fun note, is like, get yourself a theme song and psych yourself up when you're pitching. This is, as this is like 99% of the time people are going to say no to you. So, and it's hard, right? You get on this emotional roller coaster, like you're psyching yourself up. You think it's going to work, and then the person says no. And then you need to sort of pick yourself back up again and try again. So I have a number of psych up songs, most of which are by Beyonce. But I would highly suggest that is what any entrepreneur does as well.
Love it. I was going to ask, and you beat me to it. So you already gave the recommendation. So this has been a fabulous conversation, Eileen, way more than I could have expected. I really appreciate you taking the time. And I know it's going to be a super popular episode. So thank you so much.
Okay, thanks, Shubha.
And that's a wrap for today. Thank you for tuning in. If you find these conversations helpful in your own journey, please subscribe to Seed to Success, our weekly community letter with tips, insights, resources, and more. If you have any other questions relating to startup finance or financial storytelling, send them over to me at chakras@achieve.co. That's CHAKRAS at achiiv.co. We'll see you on the next episode of Invisible Ink. Now, go achieve!